Manpreet Gill, Chief Investment Officer of Africa, Middle East and Europe, Standard Chartered, joining us this morning. Manpreet, absolutely fantastic speaking with you. Thank you so much. It's always a pleasure. Just want to get the global view as far as India is concerned. It seems, and ironically I say, because in Mumbai the clouds are definitely not parting, but in terms of the overview for the Indian markets, consumption boost coming in, inflation numbers fairly benign, Fed set for another cut, and maybe Trump taking his gaze off India when it comes to tariffs. All roads are leading here.
Well, good morning. You're right. I think if I look at the various range of factors out there, I think in absolute terms, the picture is turning a little bit more positive. The question, of course, is in relative terms, where do Indian markets sit relative to the rest of Asia and EMs? And I think at this point, I'd focus a little bit more on the global drivers because we're quite focused on the Fed decision ahead, because I think that's quite key to whether the recent optimism in sort of risky assets and equity markets around regions, whether that persists. And we do see a bit of a short-term risk of over-optimism in the short term, but also the dollar. And I think, we've always been of the view that a weak dollar would be positive for flows into emerging markets, including Indian equities. And I think the good news here is that we've seen, despite, short-lived upward pressures on the dollar, the default path has still been towards a weak dollar, which we think is a positive. So once you think about that global backdrop with, of course, what's happening domestically, we do think that that does point to a slightly brighter picture ahead.
Okay. Manpreet, good morning. I mean, there is this whole interesting debate, and I'm just taking a leaf out of what you said, right? That people look at US exceptionalism for the last so many years, and particularly the last 2 years, and people thought, okay, 2025 will not turn out to be like that. It almost didn't until it has for now. And then people say that, okay, could a dollar demise and therefore a look out of America lead to the American markets underperforming? And voila, we already know that American markets are actually amongst the best performing markets for 2025 thus far, right? So does one take a bet preempting possible de-dollarization, or let it happen and then take a call? How does an investor behave? How does an advisor like you behave?
Well, I keep it simple and just try and take a cyclical view on the dollar, because to me, the big picture de-dollarization debate, that's a very long-term debate that will be with us for a long period of time. And this year, we've seen various periods where US equities have underperformed and then more recently outperformed global equities. To me, when you're trying to take a view on US versus say Indian or Asian or emerging market equities, I just say, look, are the cyclical factors for a weak dollar in place? Because regardless of what US equities do, as long as we get that weak dollar and potentially weaker dollar, if you start looking much longer out, which can happen due to a variety of reasons. It could be as simple as interest rates finally starting to come down the US and catch up with lower rates elsewhere. It could be just your relative earnings growth or valuations across asset classes. That to us is all that matters, and I think that's why we've taken relative overweights. I think in our global portfolios, the US is still obviously going to be a sizable asset class. We just want to take that extra tilt, we think, towards emerging markets, because looking through these periods of under and outperformance, we still think long term that trend will still be for US underperformance. Now, short term cyclicals matter. If I look at Asian emerging markets today, actually there's quite a lot of that optimism baked in, and to your point, the US has actually been outperforming recently. So we could see a bit of a challenge over the next month or two, and that's why we're so focused on the Fed and market positioning going into that. But to us, long-term investors, it's about looking through that and saying, will the dollar stay weak or get weaker? We think yes, and that's enough for us.
Right. Manpreet, this is Harsh also joining in. I'm curious to know, and bringing the subject back home, we've seen so many measures taken by the government to boost growth, and India is a growth market. This slowdown in growth likely also one of the factors that's weighing on markets in India, and a large contributor to that is FIIs. Does the FII picture change or the viewpoint change as a result of all of these measures that the government has taken, both on growth as well as on Indian markets?
Well, if you look at the cross-section of views out there, the answer would be yes. I mean, if you think about, a cross-section of FII views around the market going back 6-9 months, you could see quite a few, very vocal sort of pessimists. I think today we've seen less of that. But I think it'll always be a combination of the two factors. I think it's about the absolute story to say, look, are those sort of policy stimulus measures likely to pay off? I think the fact that we've got quite a few already, means that we've gone through a period of fairly subdued earnings, means the outlook starts to look a little bit better. Of course, we'd all be happier with slightly more inexpensive valuations. And then there's a relative picture, right? To more of those FI flows in relative terms flow to India or elsewhere in Asia. So there are two-step sort of process there. I think when you think about FI flows in absolute terms, I think I'd come back to the dollar because that still is one of the biggest determinants. Because even in an underweight or a neutral scenario, you could argue that Indian equity should still benefit in a weak dollar from some FI flows, even if a larger share go elsewhere. But without that sort of weak dollar, it's quite hard to sort of make a case for strong FII flows, regardless of the view on the domestic economy. The only good point I'd say is that yes, I think we've been through some weakness. We've got a lot of policy measures. That's why we're also retaining our overweight on Indian equities domestically, because we do think there's enough there now, as long as we just get less bad news, to deliver outperformance versus bonds and cash.
Okay, that's interesting, Manpreet. When we say less bad news, I would say you've seen incrementally good news, perhaps. How are you looking at the impact of the GST rationalization, which will start showing up in consumer behavior September 22nd onwards?
Well, to your point, incrementally good news. I guess I'm always sort of looking at where we are relative to what markets are pricing. And I think the GST is a great example, again, of a steady trickle of policy stimulus. I mean, look at the estimates out there, anywhere in the region of half a GDP, growth improvement, plus obviously, help sort of cap inflation. So there's no doubt that from a growth stimulative perspective, it is a positive measure. But I think where it starts to really add value is when you look at an aggregate with, RBI rate cuts in the past. We obviously started the year with more support for consumer consumption. I think when you aggregate it all up, and the fact that coming to the less bad news part, less bad news on the trade front with the US, at least some, we're in a slightly better place than where we were a few weeks ago. All of that adds up to a little bit more positivity. And I think that's why through, some of the volatility, we've been happy to retain our overweight on equities. And that we think it's about return expectation as well. We're not expecting a return to the heady days of high double-digit returns, but we still think it's a better place to be than, holding out in bonds or on the perceived safety of cash.
Okay, you're obviously constructive India, if I can call it that, in slightly more subtle terms. Just trying to understand what do you believe will be the pockets of beneficiaries in India as a result of all that's happening domestically, as well as with an eye on the globe. You have Europe, which seems to be bouncing back a bit in terms of economic growth. India could be a beneficiary to that. Give us your sense on what the sectors are which you seem to be tilted towards.
Sure. And just to address your point, you're right. I think the issue is more that in absolute terms, we are positive. I think that relative discussion is where we face more of a challenge. So relative to Indian bonds and cash, we still think equities are a better place to be. But relative to Asia, I think that's where we're still more neutral in Indian equities. We still think there's room for China and Korea to outperform, continue outperforming for now. And I think that's where my comments are a bit more balanced. I think from a sector perspective, not a lot has changed in our views. I think one of our top picks, of course, is consumer discretionary and financial. And I think the common thread that runs through both of those top down is the fact that they're much more tied to the domestic growth story with relatively less sensitivity to what's happening in the rest of the world. And that's not a theme we're taking just in Indian markets. It's a common theme in Chinese equities, common theme in US equities. In a world where there's much more uncertainty about trade, we still think getting more domestic economy sensitive sectors is a relatively better place to be, and that's why earlier in the year we sort of cut our technology sector overweight in India as well. So I think that's really the heart of our sector picks. And at the end of the day, if any of these growth stimulative measures do pan out as we expect, we should start to see the benefits first appear in consumer spending data on the margin. And hence sort of why we sort of pick that as the first sort of port of call from a sector perspective.
Preet, a very critical question is this. The Indian market's relative underperformance to MSCI Asia ex Japan is the widest in 30 years. So India has underperformed. One of the reasons would be slightly lower growth than anticipated, which the government has tried to correct, and Q1 GDP was very strong. Two, the current thawing of the India-US equation, maybe India-China equation as well, does all of this lead to FIIs taking a bit more sanguine view on India? Have you heard anything to that effect in the last 7-8 days as the combined impact of all the three, GST changes and growth, the exchange between PM Modi and Donald Trump, as well as PM Modi's visit to SCO summit, is all of that starting to show in investor mindset?
It is, it absolutely is. And I think it comes to where we started the conversation that all of these are positive on the margin. So I think we've gone away from that relative negativity to a more balanced sort of range of views. The other point I'd add, though, to your point on some of the biggest underperformance in 30 years is that it's not anything to do with Indian markets, actually. It's due to the fact of just how big a rally we've seen in some North Asian equity markets. I mean, if I look at the surge in Korean equities, for example, which have quite a big weight in the MSCI Asia ex-Japan index, I mean, that by itself has been remarkable in its size. And just to give you perspective, that's one sort of overweight we had in place and one trade we've actually taken profit on because we think it's gone almost too fast, too quickly. So it doesn't have to be just factors specific to India, but also just the speed and scale of the rally we've seen elsewhere. Look at the scale of increase in margin financing in China, for example. All of these also point to, in relative terms, perhaps that outperformance in North Asia has gone quite far, and that's something we'll be relooking at over the coming weeks, whether we want to retain that or not. But Korea is one trade, for example, we have sort of trimmed a bit of profit on because we do think it has gone a little bit too far, too fast. So all of that, this I think is an additional factor which can help cause a little bit of reassessment, saying, am I happier, reallocating to a market that may have underperformed recently?
Little bit of assessment. That's interesting. Where is that positivity flowing in terms of sectors, Manpreet? Are you, excited about what the financials will do if you have an overall consumption boost? Anything specific that you're looking at? Maybe a retracement of the companies that were hit by the tariffs?
Well, we take a more of a top-down view on sectors. And I think the two I'd focus on is that we discuss consumer discretionary, but you're right, financial is another place, which is more of a domestic exposure as opposed to sensitivity to what's happening elsewhere. But at the end of the day, you think about financials, right? At a macro level, the two big drivers are, holding up of credit quality and what we're seeing on yields and the yield curve. And I think as long as we see growth stay supported, or to our earlier comments, see incremental positivity or less bad news, and we see the steepness in the yield curve sort of persist, we think that, of course, will be enough for the sector to still be a top performer. But I think the big sort of theme we're trying to take is we'd rather have domestic exposure because that's what policy is aimed at supporting, and that sort of avoids having too much sensitivity to what's happening on the trade front. That's sort of where our focus would be as far as our India exposure is concerned, if we had to take sector picks.
Manpreet, short on time, but I'm going to squeeze one quick one. I want to try and get your sense also, rate cuts on the anvil for the US. How much are you building in? What's your opinion and what's the Standard Chartered view? Also, is IT likely going to come back into favor as a result of that? Indian IT I'm talking about.
So rate cuts, yes. In our view, what we saw in the US job market, I think cemented the debate about rate cuts into a rate cut. I think the debate is really about whether we get a quarter point or half point rate cut. In our view, we do think we'll get half point by the time we get to year end. At September, we're leaning a bit more towards 25 basis points, but I can see the case for 50 as well. The real issue here, of course, is whether that will be enough to stabilize the job market. And if I look at market pricing, there's quite a bit of optimism priced in terms of 5 to 6 rate cuts going out over the next 1 year or so. So I think in the very short term, there's a risk of optimism building into the meeting and perhaps having a little bit of a disappointment thereafter if we don't get quite as much dovishness as markets are expecting. But in the bigger picture, I wouldn't worry too much about that. Any sort of pullback, I'd see an opportunity because we do think the Fed has switched, will switch to mode of supporting growth rather than worrying about inflation. So knock-on impact, yes, look, technology may be a sector that should benefit from that, but for the technology sector, arguably a bigger hurdle is some of the trade tensions between the US and India. So if we saw some of those start to calm, as we already are, or if we're surprised by some sort of resolution, I think that's really what we'd look for before reconsidering our views on the IT sector.